Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 7th of December 2023. So we have seen a big sell-off in the dollar yen and all the other Japanese yen crosses. This is in response to a speculation that the Bank of Japan could be about to drop its negative interest rates policy following the Bank of Japan's governors meeting with the Prime Minister earlier today. So the dollar yen has fallen in excess of 300 pips, down 2.5% nearly on the day. So it's a big move and one that cannot be ignored. Key levels have broken down, so keep an eye on the yen because it could continue moving lower in the days ahead, especially with lots of important economic data coming up from the US as well. We have nonfarm payrolls on Friday. Then next week, US CPI and FOMC meeting is also scheduled for next week. The Bank of Japan, by the way, will be meeting the following week. So it's going to be a very interesting end to the year with the major currency pairs all moving sharply in recent times. So in terms of the key levels to watch, 146.22-ish is the previous level that had provided some support last week or earlier this week rather. We've broken below that today, so if in the upcoming sessions we bounce and retest this level, then I would expect some sort of a reaction there. We may not get a pullback that deep, which means that it may be a better option to zoom into your lower time frames and look for resistance levels on the hourly or lower time frames. On the hourly chart, you can see that there was a bit of a pullback earlier today before the resumption of the downward trend. Interestingly, that happened around the 145 level, which is a key psychological level, which is now, I think, the most important short-term level to watch on the upside. So if we get a pullback to 145-ish in the coming days, then I would expect the resumption of the downtrend around that area. So 145 was actually a key resistance level back in June. We broke above that level, retested it from above a few times, which held. So far so good. The trend was bullish until we broke below the 21-day exponential moving average, which then led to a continuation of the downward move in the days and weeks that followed. The breakdown happened in the middle of November. But yeah, 145 was a key level of resistance and support in the past. So the fact that we've broken below it now is significant. Therefore, a pullback to 145 from underneath could turn into resistance moving forward. The next level of support is probably 142.30, which is where the 200-day moving average comes into play, right about here. Below that, then you're talking about the lows that were tested in the summer months at around 138-ish. 140 is obviously a psychologically important level, so make sure you keep an eye on that as well. Okay, let's move on. It's worth keeping an eye on the pound against the dollar because we have rate decisions coming up next week from both the Bank of England and the Federal Reserve, as well as all the economic indicators I mentioned earlier from the US, including the nonfarm payrolls report on Friday. The cable has been trending higher ever since bottoming out in October. It has moved above the 200-day moving average, broken lots of resistance levels, and now it is back down to test 125.50-ish to 125, the psychological area, which had previously offered resistance before we broke above it. And now that the cable is testing 125.50-ish from above, we could see a bounce back as the previous resistance level turns into support. Notice that we are now above the 21-day exponential moving average as well, which is an indication that the short-term trend is indeed bullish. Gold is also looking interesting because it has created a new record high this week before plunging. It took out the previous high made in May, on the 4th of May at 2081 before moving lower to close the Monday session sharply below where it had opened. So this is potentially a bearish looking reversal candle, but the underlying trend is bullish, as indicated, for example, by the rising 200-day moving average and the 21-day exponential as well, providing some support. Key support comes in at around this level right here at the 2010-ish, which had been resistance in the past, and now it's offering some support. So let's see if support can hold here despite the bearish looking candle that was created earlier this week. If we get some further weakness in bond yields or US data, we can certainly see gold go back to retest those old record highs at around 280-ish. It's certainly not out of the question, but the shape of the candle that was created on Monday is certainly scaring some of the bullish investors away from investing in gold. So let's see what happens in the next several days as the macro events come out from the US and as we head towards the final weeks of the year. So far, I think the bulls are not too concerned because of the fact we haven't seen any significant downside follow through despite this bearish looking candle. So it could be a trap for the sellers. So if we continue to see gold hold its ground here and establish a base, then in all likelihood we could see another move to new uncharted territories in the coming days. But watch out for this level of support I mentioned. If that breaks down, then we could see a deeper retracement. So at this stage, it's kind of in no man's land really. Let's see what the next few days brings out. Now the FTSE has been quite frustrating really. It hasn't moved much at all in the last several weeks, months even. But the underlying trend is bullish. It's continuing to make higher highs and higher lows. And previously I was talking about 7,450, a level that had been support and resistance. It got a little bit ugly as price went around this level several times. But essentially we are still creating higher highs and higher lows. So a move to the 200-day moving average, which comes in at 7,570-ish, should not come as major surprise in the next few days. The US stock markets are also looking a little bit fatigued, but this is bullish consolidation following a sharp move up in November. So this is what the bulls would have ideally liked to see rather than a correction, a sharper correction. This is bullish consolidation. So once the phase of profit taking ends, the bullish trend is likely to resume, and we could be heading towards a new record high on the Nasdaq 100, which was last hit back in 2021. So there's still some distance to go to reaching that, but right now the trend is still looking quite positive for the stock markets despite the recent pullback. For more insights, make sure to check out the news and analysis section at cityindex.com. I'll be back in the next video. Take care.